We'll be recapping the week's top stories. Jon Nadler and In the Lead is coming up. Oh boy, Jon, wake up. The summer doldrums are almost over.
Oh boy, thanks for waking me up, Daniela, and welcome back, by the way.
I guess I haven't missed much, right, Jon?
No, not a whole lot at all, I would say. You've missed some central banks being reluctant, as ever, to hand out all sorts of QEs. You've missed Mr. Draghi's words wearing thin about 2 weeks after they were uttered. You've missed a giant range of trading in the metal complex, which turned out to be not so giant. And you missed some very thin participation on the part of players, which made for outsized moves on occasion, but mostly for dull and boring moves, which is what put us all to sleep. That said, welcome back, and let's hope that September proves more exciting.
Well, that's what I've been told, Jon, is, hey, let's just wait for September. We might see some action from the Fed that month. Is that what you're waiting for?
Not particularly. I think that, aside from some posturing perhaps to come from the Jackson Hole Symposium, the Fed might hold its ammunition even at the upcoming meeting in September. Because at the end of the day, I think the Fed is quite cognizant of the risks involved in unleashing another round of QE, but more so of the rewards of unleashing a said QE. In other words, that the rewards might not be there for increasing the balance sheet of the central bank, and they might not budge the overall picture in the labor market all that much, and perhaps stimulate asset purchases to the degree that the Fed would like. So I'm not so sure that is coming. Certainly action might be coming, because I think a lot of the traders who are currently not in the market will be back in action and will try to position themselves ahead of the seasonal demand for gold, which hopefully will reemerge, even though India is facing poor monsoons and what have you. But I'm not convinced of the risk and reward ratios here being anything but equal. I think there's about $100 risk to the upside in gold from this 1630 level, and probably $100 downside risk in gold from the same 1630 level. Let's also not forget that we started the year trading at about 1600. So where are we? More than halfway of the year through.
So that's interesting, Jon. You think we might see a $100 move downwards?
I think that support that was there at 1525 will need to be tested again. And in the words of one technical analyst, whose article I quoted a couple of days ago, there is that risk that if that is breached, then we could in quick order see possible lows somewhere between 1250 and 13 or 1400, hopefully, which will elicit enough physical buying among would-be holders to provide solid support. But the jury's out on this, primarily because gold has now been trading beneath its 252-day moving average for several weeks. And the last time around that happened was in 2008. And I don't think we need to remind our viewers what happened in 2008.
Right. And I've heard that we might see an orderly ascent to 1680 for gold. Jon, I don't want to stay too much longer on price with you, but was just wondering what your thoughts were on this.
No, and I've heard that same figure. And I think if I had to make wild guess, I think even 1730 is in the cards. As I said, about $100 upside risk from here. But the gains to be achieved are tenuous. I mean, they would come upon a background during which the dollar isn't weak, the euro certainly isn't strong, and all of the other metrics that are crucial to the gold market, namely ETF investment growth or physical demand out of Asia or India, is not there. So, these would be paper gains primarily precipitated by speculators playing heavily in futures and options.
All right, Jon, don't want to say too much on price. I have two news items I'd like to address with you. First, while I was gone, CFTC dropping the silver manipulation case. Is it going to be buried once and for all, you think, Jon?
I don't think that'll be the case. Certainly, the Financial Times and the story in the British papers seemed to allege that the CFTC's case would be dropped. Commissioner Bart Chilton came out later and said, well, this isn't verifiable. It's possibly premature to declare this. We have to see until actual official announcements are made on this front. But the fact that, it took several years and that solid evidence of such nefarious activities in the silver market were not produced does speak volumes, and I think the papers picked up on this early and possibly had an inside leak as to the dropping of the case. If the case is dropped, I don't think the stories surrounding manipulation in the marketplace will cease. Certainly, it makes for great, fodder for fairy tales in the gold and silver bug community when explanations of price declines are lacking. So, to be continued.
All right, second news item, Jon, is Israel and tensions in the Middle East. Is this a news item that's not being paid enough attention to that could impact the gold market?
Well, if you're referring to Israel vis-a-vis Iran and the geopolitical tensions in the area, I think it continues to be a background factor of some worry, either as relates to the disruption of oil flows in the region, or through some geopolitical upheaval whereby the whole region sort of goes up in flames. I don't think that the story has been neglected necessarily, but I think that the worst in outcomes is unlikely to happen, and it shouldn't be the one catalyst that people hope for to move gold prices. I mean, that's disaster, and that's not what anyone should wish for, really.
All right, Jon, let's talk about palladium now and that big deficit we could be seeing with the metal in 2013.
Indeed, the platinum group metals complex has had also a difficult summer. Obviously, car sales and car deliveries in China haven't been all that robust since the beginning of the year. We've had Europe primarily focused on keeping afloat rather than going out and buying a set of wheels. So demand for the noble metals has been basically lackluster, and they've suffered in price right along with gold and silver.
Yes, and sorry, Jon, you say we could see a deficit of 930,000 ounces of palladium in 2013, right?
Right. I mean, we've seen the latest in projections from HSBC, and what the indications are that within the span of about less than 24 months, the palladium market will have gone from a surplus, i.e. in 2011, of over 1.2 million ounces to a possible deficit of above 940,000 ounces. That is a huge swing, and it comes on the back of difficulties in production in South Africa, of course. Many a producer are outputting metals in this sector, platinum and palladium, beneath what it costs to make an ounce of the metal. And of course, if Russia's state-owned inventories prove to be exhausted by the end of this year, then that deficit could indeed be a solid one, and it could lead, obviously, to some price gains of some order of magnitude, which could outpace those possible in gold and silver. So it is a factor to keep an eye on. Platinum, not so much a deficit situation, but certainly a shrinkage of its surplus too, towards the 100,000, 200,000 ounce level.
So palladium might prove to be the metal to watch, Jon?
I think it will be the one or two, perhaps along with rhodium, to watch going for the next year to 2 years out. Yes.
Jon, thanks so much for your thoughts today.
You're welcome, and I'll now return to my snoozing.
Okay, happy sleeping, Jon. We'll see you next week. In the meantime, you can email me any comments or questions at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.